Thanks for joining us on this edition of Business Daily. Coming to you live from Seoul, I'm Lee Ji-yoon. But before we get started, let's first take a look at today's highlights. The U.S. Federal Reserve has finally raised its interest rates for the first time since 2006. Why does this matter so much for the U.S. and the rest of the world? We'll sit down with an expert for analysis and reaction following the liftoff. Denmark is the place to be if you want to start a business, according to Forbes. As for Korea, the magazine has ranked it 33rd, down one spot from last year. After much anticipation, the U.S. Fed Reserve finally made its move, carrying out the first rate hike in nearly a decade. It's a significant step away from measures rolled out during the global financial crisis. Our Shin Se-min tells us more.
It was a liftoff everyone had been waiting for. Ending its 7 years of quantitative easing policy, the Federal Reserve announced it will increase the federal funds rate by 1/4 of a percentage point, bringing it to 0.25 to 0.5%.
Since March, the committee has stated that it would raise the target range for the federal funds rate when it had seen further improvement in the labor market and was reasonably confident that inflation would move back to its 2% objective over the medium term. In our judgment, these two criteria have now been satisfied.
Saying that further increases will take place gradually, the FOMC added the rate hike reflects the committee's belief in improving conditions in the U.S. economy and that it hopes to see continual strengthening. The U.S. labor market added 211,000 jobs in November, totaling some 2.3 million jobs in the past 3 months. And the Fed is hopeful that inflation is starting to climb toward its target rate of 2%. The Fed's policymakers say they expect the short-term rate to stand at around 1.5% by the end of 2016. They forecast that number will increase to 2.5% by the end of 2017 and will not get close to normal levels of around 3.5% until 2018. In response to the Fed's decision, Korea's senior government officials gathered for a meeting early Thursday. The country's Vice Finance Minister Chu Hyung-wan assured that the fundamentals of the Korean economy are solid enough, adding that the impact will be minimal. The officials also promised to beef up monitoring market developments and said contingency plans will continuously be updated and rolled out if needed. Shin Se-min, Business Daily.
And with that, let's now get a quick check on how the markets fared here in Seoul today. Seoul shares ended higher on Thursday as uncertainties surrounding the U.S. interest rate hike were alleviated after the Fed announced it would raise its rates by 0.25 percentage points. At the closing bell, the benchmark Kospi was up 8.56 points, finishing the day at 1977.96. While the tech-heavy Kosdaq also went up by 10.84 points to end at 658.11. The Korean won, meanwhile, ended at 1,180.1 won against the U.S. dollar. And to tell us more about this U.S. rate hike, Professor Kim Young-hwan from 성균관대 University joins us in the studio today. So good to see you, Professor.
Glad to be here.
All right, so the U.S. Fed finally pulled the trigger. It increased its interest rates for the first time in nearly a decade. But can you first give us a quick overview on how the Fed got to this decision?
Well, the basic mission of Fed, they understand, is to keep inflation under their control. And they set their so-called target inflation rate as 2%. And the latest development of labor market, especially unemployment rate, has gone down to 5%. And they regard 5% as a kind of critical level. If the unemployment rate goes lower than 5%, they perceive kind of so-called inflationary pressure will be increased. So expecting that possible future increasing inflationary pressure, we can say they have taken some kind of preemptive measure to prevent possible inflationary pressure in the futures. That would be one reason. And the second reason might be with the unprecedented low interest rate near to zero, they have perceived there might be some increasing kind of risk of the asset price bubbles as has been experienced just before the financial crisis. So by increasing interest rate at gradual level, as we have observed, they expect that those speculative incentives might be somewhat controlled, and also they can take some preemptive measure to prevent possible inflationary pressure in the future. So that might be most important driving force for this decision.
All right, then what's the outlook like for further hikes down the line in the new year?
Well, as reported, also they perceive so-called normal long-run equilibrium rate for the interest rate would be, they perceive somewhere around 3.5%. So the current interest rate is far lower than the so-called long-run equilibrium rate they perceive. So really highly likely that they will keep on increasing their interest rate, getting close to the so-called normal rate, 3.5% in long run. But however, they also perceive there are lots of uncertainties and still ongoing kind of downside side of the depressionary kind of features in lots of the economies, including EU and Asian economies and other emerging economies. So they also recognize that it is not a real proper time to just keep on increasing interest rate. They also they are worried about some possible negative impact of the continuous interest rate hike. So according to their own terminology, so-called, they will try so-called much more comprehensive and also so-called accommodative monetary policy, taking consideration of the possible downturns in the process of their monetary policy. So if they perceive any negative shocks, like some still sluggish inflation rate or some downturn of the real economy, it is highly likely that they might stop and pay attention how the market turns out.
All right.
So, but their basic plan for now is to keep increase of interest by 1% annually, eventually getting
1%.
to the norm annually. So eventually targeting to increase interest rate to so-called long-run equilibrium 3.5% by 2018. But still, they are quite cautious, and I think they are taking very gradual and cautious approach.
And like you said, this has been big news for a lot of countries around the world, especially for emerging markets.
Right.
How do you see this rate hike affecting the emerging markets?
It has already affected quite a lot.
Right.
So, and we can see they have been massive capital outflow from emerging economies. And those trends of the massive capital outflow from emerging economies are somewhat higher than the massive capital inflow after the so-called quantitative easings. So quantitative easing was the major reason for overflowing monies in everywhere. And those massive increase of money supply initiated by the United States has eventually flown to the emerging market, since they wanted to find some marginally higher kind of profit from their investment. And then with the coming imminent interest rate hike, those so-called possible worry in the market has been already reflected in the emerging market. And well, what would be the future of the emerging market, say in terms of negative shock by this interest rate hike? I don't think, say remaining shock might be that high, since it has been already reflected in the market.
All right.
And as we observe, even in the stock market index in China or other emerging market, what we can observe, say, in recent period is not that negative, although there might be some continuous capital outflow, not that kind of devastating levels.
All right, then what about for Korea? Even if it doesn't see massive capital outflows like the other emerging markets, there would definitely be some kind of impact from this rate hike.
Sure, and as like other emerging economies, we have already suffered second negative impact. So in case of last November, we have suffered also massive outflow of foreign capital from our stock market, and it reached almost like $1.2 billion. That's a lot. And however, say, as we have observed from today's stock market, say, well, all those possible negative impacts have been already reflected in the market. And so I don't expect there would be any more real serious again, another devastating impact on Korean financial market or real economies. But some possible story would be among the emerging markets, South Korean economy is performing relatively well in terms of macroeconomic performance, and in other financial kind of indexes shows a rather more what kind of stable pattern. So if those hot monies are wandering around among the emerging market, it is also expected that some money might regard South Korea as a kind of safe haven among the emerging markets. So some pros and cons, but still in general terms, we cannot really say all this international environment is not that what kind of positive. We should be alert, I would say.
But then it's still good news that the U.S. Fed seemed quite confident that its economy is back on track. It's on a recovery track. Then wouldn't this be good news for Korea as well?
Well, if U.S. economy is really, say, recovering in solid way, say, solid enough to provide larger demand on Korean products, yes, definitely it's a good news. But however, there is some kind of suspicions whether recent economic recovery of the United States is really reliable and real solid one. Say, although unemployment rate has gone down to 5%, still, so what we can observe is so-called labor market participation rate is kind of way low than the usual level. So I would say there is still some lack, say, in the U.S. Labor markets, and also U.S. economies also depend on other emerging economies, especially Chinese economies. And China has shown continuously kind of quite a sluggish pattern kind of performance of their economies. And this rate hike will definitely affect somewhat negatively to Chinese economies. So considering all those environment, well, we are not really sure that demand from U.S. on Korean product will be really increased significantly or not. I think we should be cautious.
And well, you talked about China a little bit, but what are some other things, other movements that we should keep an eye on from here on out, now that the rate hike is done in the U.S. and also in other global markets?
Right. So as you pointed out, there is some increasing disparity between the monetary policy between major economies. For example, European economy is going just far opposite way than the United States. They will keep on. They have announced that they will keep on expansionary monetary policies, and also they are trying to take some counter policy to kind of take over all the somewhat restrictive impact by the Fed rate hike. So those continuous some kind of uncoordinated monetary policy might produce some another instability in global financial market. And also, as you mentioned, Chinese economies, will kind of show some continuous sluggish performance. They will definitely kind of depreciate Chinese yuan. Again, another negative shock on most emerging economies. So I would say from now on, including US Fed and also European Central Bank, they should pay more attention on coordinating their monetary policy. If they keep on this kind of uncoordinated approach, probably the increasing instability in the global financial market will be increased, and that's a real bad kind of signal for whole global economies.
All right, definitely a lot to keep an eye on in the new year.
Exactly.
Thank you so much for coming in today, Professor.
Thank you.
Korean banks have raised interest rates for housing loans beyond the 2% range in anticipation of the Federal Reserve's now confirmed decision to push up interest rates. This is due to the rise in the cost of fund index, or KOFIX, the benchmark used by banks to determine their mortgage loan rates. It climbed nearly 0.1 percentage point on month to 1.66% in November. Now, this puts the rates at most banks above the 3% mark. KB Kookmin is the only commercial bank in Korea that has maintained mortgage rates in the 2% range. But it too is expected to see figures top 3% next month. The largest margin of increase this year in the KOFIX recorded in November was attributed to the much anticipated Fed rate increase. Meanwhile, Korea's Finance Minister Choi Kyung-hwan said the country's overall growth potential is expected to fall due to the country's plunging birth rate and aging society. At a mid to long-term strategic committee meeting on Thursday, he said the economy must see dynamic and innovative changes in the face of unfavorable conditions, such as slowing growth worldwide and weakening exports. He added that the government has been working hard to deliver changes in the labor, financial, public, and education sectors, but expressed concerns over reform bills still pending parliamentary approval. If you're looking for a country to start a business, Forbes reckons Denmark is the place to be. The magazine has ranked the country #1 on its prestigious Best Countries for Business list for this year. Korea, meanwhile, slid one notch from last year to 33rd. Our Son Jung-in has more.
Forbes gauges the business friendliness of the world's biggest economies and releases the results every year. And this year, Denmark has ranked #1 once again. The list grades 11 different factors such as property rights, corruption, freedom, and investor protection, with each category equally weighted. Denmark scored high in all of the categories measured, but particularly well for personal and monetary freedom and low corruption, offering a transparent and efficient business climate. European countries, despite their sluggish economy, dominated the ranking, accounting for 2/3 of the top 25. New Zealand moved up one spot to #2, followed by Norway, Ireland, and Sweden to round out the top 5. The US-based magazine ranked South Korea as the 33rd best place to do business, down one spot from last year. The United States tumbled 4 spots to rank 22nd, scoring poorly on monetary freedom. The world's other biggest economies improved their overall standings. The UK and Japan both moved up 3 spots to #10 and #23 respectively. China rose to 94th. 144 nations were graded this year based on data from international organizations, including the Heritage Foundation, World Bank, and World Economic Forum. Son Jung-in, Business Daily.
And that wraps it up for today. Thanks so much for watching, and we'll be back tomorrow at the same time, same place for your Business Daily. Until then, goodbye.